Mr. Mark Selby, how are we, sir?
Mr. Matthew Gordon, doing very, very well.
Good. It's a sort of quiet-ish week for nickel, but I thought, it's worth catching up anyway. Because we had a really good and strong session last week. Definitely worth watching. Everything was said last week still holds true. But what's happening with the nickel market? Because we had a bit of the conversation I remember from last week, which was it's just stay the course. It's going to be a bumpy ride, but it's going to be worth it. What's happened this week?
Yeah, so again, nickel prices with a massive move from below $10 a pound or below 22,000, clear through that up to almost $24,000 a pound briefly, and then it retraced all the way back down to about 20,500 or 10.15 a pound, and it's come back to the 10.45 level. So again, some pretty volatile moves, and we've seen that 2 or 3 times over the last year, and again in this kind of major shift happening when inventories start to get to relatively low levels, the bulls and bears can really start to wrestle with each other. I mean, fundamentally, what's been helping, give the bulls courage is, inventories keep grinding down. On the exchange inventories, we've seen another 4% decline on the LME, just down to about 95,000 tons. The inventories on Sheffield are down to 4,000 tons, which is about 2 days worth of Chinese consumption, and that was down another 8%. We're seeing ore inventories doing their seasonal drift down. So sort of with all of that shrinkage of inventories, you had a backwardation in the LME price. So it means cash price higher than the 3-month price, which implies that there is tightness with that inventory. And again, just because there's inventory on the LME, it's possible that there are 2 or 3 players who actually have most of it locked up. So actually, if you're not one of those 2 or 3 players and want it, it can get a little more expensive. And sometimes when you see that backwardation pop up, that helps. Those massive swings in the price, obviously when you have sulfate and nickel pig iron, that show up relative to that, we saw, some pretty wacky, premium discounts. So, sulfate was at a multi-$1,000 per ton premium. It went down to negative briefly there as prices went through $11 up towards $11. We'll see what it comes back at this week. NPI prices, blew out to pretty big discount at some point. They're almost down like almost $4,000 a ton. Again, if you watched last week, one of my big themes for this year is you're going to see a lot of nickel pig iron production coming from Indonesia. It can only go, into Indonesia and China, basically. So the Chinese NPI is trapped in China. And so that Indonesian NPI is going to put the hurt on Chinese NPI this year. So you are going to see some big discounts on NPI prices. The key thing there, that's not going to be permanent. That doesn't imply that the nickel market, is fundamentally out of balance. To me, it's that mechanism that even if we do have short-term surpluses show up, during the next 12 months, it's that mechanism that's going to squeeze Chinese production down to get the market quickly back into balance. And again, this shift to matte production from the NPI guys, which is the whole thing going to blow up this class 1 versus class 2 nonsense that people have been talking about for far too long. You're going to see a huge shift over to matte happen with those discounts blow out. So, it's a very, that's going to be a very healthy mechanism for the market for the year.
It's quite interesting, actually. There's a lot of parallels to the uranium space. There's quite a few uranium investors in here, in the sense that the supply demand fundamentals are really, really strong. Supply is being squeezed as, one, because there's no price incentive there, in their case. But secondly, big producers have come off because of COVID concerns, etc. So but despite those strong fundamental signals, there's been a mass exodus from uranium, because I think the types of investors that were drawn to those kind of big volatile moves and gains that we saw, a couple of times during the course of last year, they've been scared off by the fall. There's kind of this drop off, because all of a sudden the story doesn't seem to make sense, despite the fundamentals being there, as per nickel. The equities are seeing, someone taking like 40% hits, 40% hits, right?
Yeah.
Nickel, it's although it hasn't kind of followed and tracked the nickel price increase, it hasn't seen those sort of volatile moves off. Is that because the the type of nickel investor that's out there? Is it what would you put that down to? Because because I just find that kind of whole sentiment-driven investing interesting. It's not one I kind of understand, advocate, or subscribe to because I'm a bit more fundamentals. But you can't discount it.
Oh no! They play a major part of the market. And the thing, what's interesting is if you look at ASX stocks versus TSX stocks, most of the TSX nickel stocks are down from their peaks last February. And where you've got nickel prices at 10-year highs, and whereas on the ASX, all the nickel stocks have moved consistently higher. And the difference I think there is people in Australia have there's a group of investors who invest in nickel in a much more knowledgeable way and realize that you do get this short-term noise. But there are more sort of medium to long-term fundamental players where I don't think we have nearly that many, unfortunately, in the base metal markets in North America anymore. And so we just haven't seen the move in the nickel equities that you would expect with this kind of price movement.
Yeah, and I guess they have been distracted by a few other things, and obviously the Fed at the end of the last year didn't kind of help commodities generally. I think a lot of people moving to cash positions or increased cash positions as part of their portfolio. So I guess we'll see how that plays out. So message hasn't changed. I'd hope not over the course of a week. Stay the course. The kind of general trend is up.
Oh, for sure. And just on that point, click with last year in February, stocks ran up. Tsingshan made that announcement. Nickel prices fell off. The stocks had probably moved up 40 or 50% from Jan to Feb. And then they just went on this, this downward trend where, all of them bottomed between June, July, August, September of the year. And again, it's like, well, you bought them in January, you obviously, or I was hoping you were going to hang on, it was because there's a longer term EV story. But again, like you said, all of a sudden you get a change in short-term sentiment and, those guys have hit the exits and stepped away. But, again, if you're a longer-term fundamental story, it's those guys, hitting the panic button, that create those buying opportunities. If you picked up, even with the TSX not having that move like the ASX has, if you picked up your favorite nickel stocks, in May, June, July, August last year, you would probably be up anywhere from 30 to 70%, which is decent for 6 months. So.
Yeah, and I think the other part of this, because before I come on to some M&A stuff, the other part of this, and there's a lovely line I read in a conversation going on in social media, which was someone comes up with the cliched line, a high tide floats all boats, to which some charming chappie wrote, and turds for a while. Just thought, how true. Yeah. It's quite clever, because there are two things there. One, Le Turd being the not so good companies, and the for a while is quite insightful, So that's momentum investing summed up in one lovely sentence for you. Hey, look, I do want to talk about M&A. So we saw the Sibanye Stillwater deal with Appian fall over. And I want to talk about that because it made me think about some of the things you said last week, right? So, well, why don't you describe, the deal as was, and then what happened, and we'll take it from there.
Sure. So, Appian picked up Sibanye picked up Santa Rita last fall, announced a deal with Appian, who's a private equity firm who, basically picked it up out of bankruptcy. It was $1 billion, a 5%, royalty. I think a lot of people in the market, thought it was a little expensive, but you know what? Most of the analysts behind them loved it. The things that I was impressive about it was one, they stated very clearly, we are moving out of PGMs and we are going to focus on the battery metal sector. And they did a whole series of transactions. They did a couple of lithium deals, like they would just bang, 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 bang. And again, in a mining industry that is, notoriously conservative and slow, it's nice to see that aggressiveness. And I think that value premium, and I'm sure this is what they're thinking was, when you step back and say, okay, I want a sizable asset in the nickel space, and we've talked about this before in terms of what are the mid tiers and majors looking for is they want a chunky asset, so they want a lot of production and they want a big resource base, to be able to have that production over several cycles, just in case the thesis doesn't work out as quickly as you'd like. And so, if you look in the nickel landscape, there's very, very few opportunities on them. So I thought, from their perspective, putting their fingers on that, right away to help be an anchor asset for their business made a lot of sense.
So again, come back to that point about why people thought it was expensive, because I did see some commentary around 5% NSR. Obviously, people feel that, well, there goes half the profit of today, as this thing gets bigger, that's obviously less than ideal. And of course, the amount paid, was it 1 billion or 1.2 something?
There was two assets. It worked out. I think that if you split them up, it was like 800 million for the nickel asset plus the royalty, and then 200 million or something for the copper asset.
Right. Okay. So, but we've seen the Noront deal recently. That was a similar sort of ilk. And I'm just looking at the profiles of these because, so I'm very cognizant of the way that we interviewed you on Canada Nickel recently. Okay. So, so I'm bringing a little bit of that in. So I don't mean to push Canada Nickel overtly or in any other way. I'm just saying, you said, we know what the big guys are looking for. So therefore, we're setting our company up to play it the same way, right? So let's just kind of keep this broad and go. And you've always been an advocate of we need all the nickel we can get, right? So the companies that are out there that are capable of showing scale, that's what they're doing. And this is why, because the Sibanyes, the BHPs, the Wiley's, they're all looking for this scale and multi-decade type profile. So is that true?
That's exactly it. I mean, there's the whole, from a if I was a private mine, basically a private mining company, and I had enough capital to advance my own business, I might look for smaller initial capex, that I can take the cash flow and then reinvest that back in the business. On a private basis, very doable and a good way to run your business. On a public markets perspective, there's a couple things that you want. One is in terms of the ultimate takeout. Again, you want to be attractive to as many bidders as possible, and to make sure you want as people with the biggest wallets, who at $100 million doesn't mean anything, to their financials. So. And so in order to do that, it's large scale, it's long life, it's got to be in the right jurisdiction. Those are the kind of boxes they're looking for. The other part from a public markets perspective, again, if you own a smaller junior and you're wondering, geez, these guys are doing all the right things. It's a great, great project. And then, it's been sitting at a 30 million market cap and it hasn't moved, or it's even drifted lower. Why is it doing that? Well, the reality is the investors in the space, if you need the larger and a larger group of class of investors to come into the story to help move the stock higher, they want liquidity. They need a certain market cap size. And so if they look at it and say, oh, best case, you're going to go from 25 to 60. I need to put $500,000 or $1 million to work. That's just too small, right? It's just, I'm not gonna, that's just too small an asset. So, so again, I think, again, to be able to get to that trajectory, when you want a multi-billion-dollar valuation at some point, you need to have own assets that potentially could be worth that much money. To be able to continue to attract investors higher and higher up the food chain who help pull your share price up with it.
Yeah, there's an issue. I quite often ask CEOs, what's the picture you're trying to paint? And I kind of push them on it. And I've done that a couple of times this week already. I'm sure they thought I was mad because I just wouldn't let go of it, because it was a case of, who the heck are you trying to talk to? In terms of money, who are you talking to? Are you talking to retail investors because you just want the, short, sharp, reaction because you're saying more than you actually do? Or are you trying to build this for what clearly, if you talk to me about district-wide potential, then at some point someone's going to have a balance sheet that can deliver on that. And if you're clear with me at what point you're exiting, I'm comfortable with that. Or if you keep, and I've seen this a few times last year, where they keep kind of building this thing up to a point where there's no chance on God's green earth that that team will be able to raise the money to be able to get this thing into production. And they have said, oh no, we will do this. We can do this. But they spent the whole time on that journey talking to retail, which I think is nuts. At some point, you're going to make this conscious decision and say, look, we've taken this as far as we can with our marketing, right? Yeah. And whatever the drill bit has turned up. And at some point, they've got to face into industry or strategic investors who can be presented with the data that they need, not the market friendly headline shit, but the actual, this gives us and paints a picture of the potential of the scale of this thing. You've taken it to a point. Well done you. And it's a difficult narrative to control during the course of the journey, right?
Oh no, for sure. No, there's, you talk about businesses, there's certain or sort of organizational, there's thresholds in terms of just in any business, in terms of, you can get your business to X and then a lot of them just stall out there. And then you need to do something different to get to Y. And with the mining business, it's very clearly, you can get from sort of 20 to 30 million to 200-ish, with a strong retail following. And that's really, with Canada Nickel, that's what we've done to date. A huge focus for me is we're at that pivot point now where, again, you can't get enough retail investors to buy enough stock to really move your stock through that next level. So you do need to now pivot to moving your shareholder base to be largely, a smaller and larger scale, institutional base, and start to climb up the, institutional ladder of interest. And that's, that is a huge focus for us, for this year is to make that pivot and get more of those institutional names in the story. And you have to think that way. I think you're absolutely spot on that.
And you have to think that way, but you also have to do it quickly. You got to time that right, and you got to make that pivot and do it quickly. Because I've seen a couple of stories in the last 2 weeks where for the last 3 years, it's been a little bit bumpy, but effectively you drew a line through it. It's moved sideways for 3 years because they've taken it to a point of competency and in terms of the narrative of the story, showing the potential of the story to a set audience, and they're stuck. It's like the record is stuck over and over, and they're wondering why this thing can't move. And the reason it is because they just haven't done things in the order of play for the next big step change, right? This pivot moment for that type of investor to get attracted to this thing, because there are so many stories like that out there, and they're wondering why no one's listening. And so, when I'm analyzing a company, I'm looking at the management team, sure. I'm looking at the asset, the fundamentals of the asset, sure. But I'm also looking at how that story has progressed over time and the moments at which it has made some conscious decisions rather than market-driven decisions as to where it's going. Back to my control and efficiency needs for a company. And I just, I'm surprised and stunned by, as you say, the amount of sort of $250 million companies who wonder, well, why aren't we breaking out of this? Well,
I get it. It's in many aspects of life. It's like you're the world's best bar band, right? And you haven't figured out how you can pack a bar 350 nights a year, but you just can't figure out how to get to a 2,000 seat venue, right? So that is the analogy. So
there you go. I'm sure we've all will continue to learn lessons, but that was just something that kind of puzzled me. And when I come back to the Sibanye thing, so what do they do now? Because is that deal done and dusted? Because obviously, I think that there's some technical issues, we'll call it, which may preclude them from coming back in. What do they do now? Where do they go?
Yeah, so I mean, in terms of the technical issues, it was a wall fall. We're involved RNC in discussions with. I mean, it's all past life now. So with Lundin about their Agua Blanca asset, and they did have some pit wall issues. It came down once, and it came down a second time. And fortunately, we chose not to because the geotechnical risk was there, and the prices weren't right. So and that's why I think Sibanye is probably wisely pulling the plug. Again, sometimes there are complete freak one-offs, but generally, if there's that kind of thing happening, and particularly in a place in the tropics or in warmer climates where you can get like huge dumps of rain, it may be something that is related to that. And so, okay, if we're going to get climate change and more rain over the next 25 years, then maybe we don't want an asset, that has a pit wall that comes down every once in a while. And the other part is the economics of that deal. There's about 7 years of pit life left before they go underground, and they need to generate a massive amount of cash flow out of that pit. So if all of a sudden you take a year or two out of the pit, or lose 15% of the resource, that's a huge amount of the gravy in the deal. So I think they were absolutely right. Appian saying no way, we'll see what happens in the courts. But I would think that's probably a material adverse change, which is in most contracts, and so they'll be able to get that through. The challenge for them, and again, like we've been saying in the nickel space, is there was a list 2 years ago of nickel assets. That list has already gotten a lot shorter. All the bidding that we saw happen in December. So it'll be interesting. They have a very stated strategy to do it, and that management team, when they state they're going to do it, they've already moved pretty aggressively. So it'll be interesting to see sort of the various nickel targets that they go after next.
Yeah, really, really interesting. But again, the fascinating part of that story is like you've got $1 billion project there. Someone was willing to fork out $1 billion, right? It went wrong. And we were talking to the new CEO of Pure Gold, a gold company, Canadian, right? Yeah. And they've just got rid of their former CEO and CFO. A new guy comes in and talk about throwing the team under the bus. I mean, this new CEO has been sitting on the board since 2012. So he wasn't oblivious to this. And he basically said, the team of what was at one point $1 billion company had just got the drill plan wrong, that they had the operational controls were not there, and basically a long list of things that the team of $1 billion company weren't doing right.
Yeah.
So again, as an investor, you need to hold these guys' feet to the fire because they don't always get it right. They're as likely to get it wrong as they are right, And I just think it's salutary lesson. Just because the price is up here, it doesn't mean that it's working. And I think pit wall kind of caving in. I don't know if you can you can't sanction. You can't say. Well, I don't know. Can you see that coming? Is that? Oh no, you can't.
I am sure. Given that did happen. Again, mining is unfortunately, there's always a pile of different risks that show up, and geotechnical risk is always something both underground and open pit that you always need to pay attention to. And, given that it happened, I hope that was, geotechnical risk was at the top of the list. But you say, okay, on the balance between what we're getting and the risks that we're assuming, do we still think this is a good deal? And, again, there's no risk-free mining asset anywhere in the world. So, hopefully that was what it was. And then when it was, oh shit, it actually happened. And, maybe they had a once in 5 year rainfall, and that was the trigger for it. Again, I don't know the background behind it, but, then you go, oh shit, okay, that was our biggest risk. It did come through. It did actually happen. So that does change the value equation at this point. And thank you. We're going to take that material adverse change button. So.
All about timing. Hey, well, look, we're going to keep it nice short this week because I think it's a bit of a quiet week. Thanks for the update on markets. Stay the course still holds true. We'll catch up next week. Maybe do a little bit more company news. We'll see you then.
All right. Sounds good.